All right, let's dive right into the world of income investing. Today, we've got a tale of two funds, two completely different philosophies, and a really powerful lesson on why the shiniest object isn't always gold. We're putting VOO and SPYI head-to-head to talk about the surprisingly high price of chasing income.
And the source material for this explainer kicks things off with, well, just a perfect analogy. You've got one option that's pure, simple, and actually good for you, and then you have the other, which might seem tempting for a second, but ultimately leaves you feeling kinda gross. This quote just perfectly frames the choice we're about to unpack.
Now, let's be really clear about something. The search for a steady, reliable income stream from your investments, that is a totally legitimate goal. I mean, if you're a retiree, you need that consistent cash flow to pay your bills. It's essential. The real question isn't if you should seek income, but how you go about getting it. And that, as we'll see, makes all the difference.
And this need for income leads to what the source calls income chasers. These are investors whose main focus, sometimes their only focus, is finding the absolute highest monthly payout they can. That one number, that juicy yield, can become so alluring that it just blinds them to everything else that's going on under the hood.
So let's meet our two contenders, which really represent these two opposing philosophies. In one corner, you've got VOO, the classic Vanguard S&P 500 ETF. And in the other corner, we have SPYI, a high-yield options overlay ETF. Now, they both invest in the S&P 500, but trust me, that's pretty much where the similarities end.
Okay, so just look at this, right? The appeal of SPYI just jumps off the page. You see that yield? 11 to 12%. Compare that to VOO's, modest 1.4%. SPYI's whole strategy is to hold the S&P 500 stocks and then sell these things called covered calls to generate that big monthly income. VOO's strategy? It's simple. Just own the market and go for total return. So on the surface, if you're an income chaser, the choice seems like a no-brainer.
But that giant yield comes with a pretty big catch. And like with anything that seems a little too good to be true, you have to ask yourself, what's the price? And I don't just mean performance. I mean the literal, out-of-your-pocket cost you pay every single year just to own the thing.
So here's the first part of that cost. The expense ratio for SPYE is 0.68%. Now that might not sound like a huge number, but in the world of index investing, that is, as the source puts it, chunky. It's a significant drag on your money year after year. Now for some perspective, let's see what VOO costs.
And there's the contrast. VOO's expense ratio is a tiny 0.03%. That's more than 22 times cheaper than SPYI. You're paying pennies on the dollar for a simple, proven strategy. And that fee difference alone can compound into tens of thousands of dollars over an investing lifetime. It's a huge deal.
So if you're paying way higher fees, that massive 12% income must be something really special, right? Well, let's pull back the curtain and find out where that money is actually coming from. This is where the whole magic trick is revealed.
A huge part of the answer lies in this one little term, return of capital, or ROC. And this is so critical to understand. When you get a payment that's classified as return of capital, the fund is not giving you a profit. It's not giving you an earning. It is literally just handing you back a piece of your own money.
And the source just nails it with this quote. It's exactly like that. It's the financial equivalent of taking money out of your left pocket, putting it in your right pocket, and then celebrating your amazing new wealth. It feels like income, it spends like income, but it's not a return on your capital, it's a return of your capital. So here's the trade-off you really need to get. SPY generates those high payouts by selling covered call options. In simple terms, they're selling the right for someone else to buy their stocks if the price goes way up. Now, this brings in cash today, which is what they send to you, but the hidden cost is massive. This strategy puts a ceiling on your potential gains. So when the market has a really great year, VOO captures all of that upside. SPYI, by its very design, can't.
And this might be the most memorable analogy from the source material. You get a small, sweet treat every single month, that big distribution check. And hey, it feels good. But in the process, you are giving away a giant slice of the much bigger, more important long-term growth, your wedding cake. Over a decade or two, that trade-off can be absolutely devastating to your total wealth.
So this brings up a really fascinating question, right? If the math is so clear about the underperformance and the high fees, why do so many investors flock to these kinds of products? Well, the answer isn't in a spreadsheet. It's in our own heads.
You know, our brains are just wired with certain biases. Seeing that cash hit your account every month gives you this illusion of control and safety. A 12% yield feels like you found some secret lottery ticket that beats the market. A lot of us are also just anchored to the idea of income, like a paycheck, instead of focusing on total return, which is what actually builds wealth. And let's be honest, the flashy marketing of a high yield is just way more seductive than VOO's boring but effective promise.
So if chasing these high-yield funds is a trap, is there a better way? What should an investor who actually needs income do? Well, the source argues for a much simpler and more effective strategy that puts you back in the driver's seat.
So here it is, the alternative. Instead of paying a fund manager a bunch of fees to manufacture a distribution for you, you just create your own. Step 1, you own a simple, low-cost fund like VOO. Step 2, you just let it do its thing, grow with the market. And then step 3, whenever you need cash, you just sell enough shares to cover what you need. That's it. You are in total control.
The benefits of doing it this way are just so clear and powerful. You pay dramatically lower fees. You get to participate in all of the market's long-term growth, which means you have a much bigger pie to draw from over time. And on top of all that, selling shares and paying capital gains taxes can often be way more tax efficient than receiving all those distributions that are taxed as ordinary income. It's really a win-win-win.
And that brings us to the end of our explainer. It all really boils down to one simple but honestly pretty profound question that every single income investor needs to ask themselves.
And there you have it. Are you chasing the feeling that a high monthly check gives you, even if it comes at the expense of your actual net worth? Or is your real goal to build the most wealth possible over the long run, giving you true financial security? The choice, as always, is yours. Thanks for tuning in.